Well, I am going to read Mr. Huizinga, who's out ill, opening remarks for this subcommittee hearing. America's robust capital markets are key to our long-term economic growth. Businesses of all sizes depend on our capital markets to access financing, to get off the ground initially, sustain operations, manage cash, make payroll, and even create more jobs. Although our capital formation framework is better than it was a decade ago, it is troubling that many of today's rules and regulations have discouraged companies from going public. Unfortunately, the U.S. continues to witness a downward spiral in the number of new businesses being created, which in 2016 hit a 40-year low. The U.S. has only seen half the number of domestic IPOs that it did 20 years ago, while the U.S. has doubled the regulatory compliance cost a business must undertake. With more companies opting for private fundraising rather than the public market, the number of public companies has decreased to levels not seen since the 80s. In fact, 20 years ago, American investors could pick from over 7,000 listed stocks. Today, that number stands at merely 3,500. This means that everyday investors on Main Street, such as John and Jane 401k, are missing out on valuable opportunities to invest in the next Microsoft, the next Amazon, or the next Google. IPOs have historically been one of the most meaningful steps in the life cycle of a company. Going public, as it is termed, was the ultimate goal for entrepreneurs. You start a business from scratch, you build it into a successful enterprise, and then open up the opportunity for the public to share in your success. Going public not only affords companies many benefits, including access to the public markets, but IPOs are an important part of the investing public. By completing an IPO, a company is able to raise much-needed capital for job creation and expansion opportunities, while allowing Main Street investors the opportunity to have an economic piece of the action and the ability to participate in the growth phase of a company. For myriad reasons, the public model is no longer viewed as an attractive means of raising capital. Companies are drowning in a sea of regulatory red tape and increasing compliance costs created by Washington bureaucrats. This is truly troubling. Instead of constructing arbitrary walls that cut off access to our capital markets, Congress should be working to create an atmosphere that helps promote more capital formation, to allow the free flow of capital, strengthen job creation, and increase economic growth. However, the four draft legislative proposals that we are examining today do very little to promote economic growth. Instead, these bills will do nothing but impede economic growth. By mandating the additional disclosure requirements, it will only increase compliance costs for companies, take away precious resources that could have been used to hire more workers, increase wages, and grow these companies. Instead of working to protect investors and helping to facilitate capital formation, these proposals will be more focused on exerting societal pressure on public companies by demanding meaningless information that are not material to investors making investment decisions. The increased cost for complying with these hollow disclosures will only stifle growth and discourage more companies from going public, ultimately hurting American workers and Main Street investors. And with that, I'll yield back.
Thank you.